Well, good morning or good afternoon, all. This is Ryan Weiser from Lawrence Berkeley National Lab, and I'll be moderating the webinar today. And let me just start by simply thanking all of you for joining our webinar. We hope you find it useful, and we certainly welcome any questions or comments that you have, both during the course of the webinar, really at the end of the webinar, where we hope to have a few minutes of Q&A time. But also, if we're not able to answer your questions or you're not able to offer a comment during the webinar, certainly feel free to reach out to Andrew Mills, the lead author of this work, or me, Ryan Weiser, after the webinar has ended. The topic of today's webinar is most certainly a timely one, as many in the energy industry have become increasingly interested in better understanding the impacts of growing shares of wind and solar on wholesale power markets, and as well wholesale power market prices in particular. And so we certainly hope that this webinar and the underlying report on which the webinar is based usefully contributes to these discussions and our collective understanding. My colleague Andrew Mills, who is the primary author of the work that we'll be touching on today, will really be leading through all of you through the full content of the material during today's webinar. And I'll be turning it over to Andrew here just in a moment. But before I do that, just two quick logistical notes. First, all of you who are listening into this webinar will be in listen-only mode for the entire duration of the webinar. Second, and related though, we do hope to have a bit of time at the end for some questions and answers. And if you do happen to have a question at that time or running up to that time, feel free to insert that into the chat box or the Q&A box that should be on your screen. I'll be back with you towards the end of the webinar to lead us through, again, a short Q&A session. And if we don't happen to get to all of the questions with answers during that period, again, very much invite folks to reach out to us after the webinar as appropriate. So with that then, I'm going to head off the line and turn it over to Andrew Mills to take us through the content of the webinar today. Andrew, take it away.
Great. Thank you, Ryan. And I do want to acknowledge that this work was conducted by a large team of us at the Lawrence Berkeley National Lab, and it was funded by a combination of U.S. Department of Energy offices, with the Office of Electricity being the primary funder. The slides I'll be presenting today are a summary of a full report that's now available on our website. The last slide that I'll get to has the link to the report and to these briefing slides. This research builds on previous work that we did in support of the DOE staff report to Secretary Perry on electricity markets and reliability. The context of this research are these recent changes in wholesale power prices, the composition of the power system, and changes in the way that the power system is being operated. The chart on the top left shows the trend in annual average wholesale prices at major trading hubs across the U.S. in that blue shaded area. And you can see that there's a significant decline since the peak in wholesale prices that occurred in 2008. The orange line is the average price of natural gas at the Henry Hub, and the green line is the share of energy from variable renewables like wind and solar. We refer to these as VRE throughout the presentation. The chart on the bottom left shows generation additions and retirements over the same period, along with the peak summer demand. One of the things that's notable is the increased retirement, particularly of coal, in recent years. Along with those changes, there's been concerns that VRE are the primary cause of these trends. The questions that emerge from this discussion are: one, to what degree has VRE contributed to these trends? Two, how might those impacts grow in the future? And three, what effects might these changes have on various assets, including on VRE? We don't answer all of these directly in this research, but we do aim to contribute to that broader conversation. This analysis builds on a significant amount of past work and is meant to inform a variety of contemporary discussions in the electric sector. In terms of planning decisions, trends in annual average wholesale prices impact inflexible baseload generation assets. Variability of prices impacts the value of more flexible resources. And geographic variation informs high and low value sites and the importance of transmission expansion. And then in terms of policy decisions, the impacts relate to discussions of premature retirement of thermal plants, market design changes that are needed to access flexibility, and policy supporting VRE deployment. Considerable attention has been placed on the impacts of VRE on wholesale power prices. This is due in part because of the wind and solar rapid growth that has occurred over recent years, but also because of the somewhat unique characteristics that might have distinctive impacts on wholesale power pricing patterns. This literature consistently confirms that the addition of VRE with low marginal costs leads to lower market clearing prices. A summary of the empirical US literature is shown here in this table. The estimates of the absolute magnitude of the price decrease effect vary, with the high end being somewhere in the $5 to $10 per megawatt hour range. This variation that we see across different studies is because of various different approaches that were applied, and then also they were applied to different regions, making comparisons somewhat difficult. Much of this literature has focused on VRE impacts without consistently considering the wide array of other possible price drivers. So we build on this past literature to empirically assess the degree to which growth in VRE has influenced wholesale electricity prices in the United States. And here we're going to focus on energy prices. We won't really talk about capacity and ancillary service prices. And principally, we're going to be focusing on the 2008 to 2017 time period. Where possible, we'll also assess the other drivers in these observed trends. More specifically, we first assess the relative impact of VRE and other factors on annual market-wide average historical wholesale prices. And for this analysis of the drivers of the average wholesale prices, we use a simple supply curve model that tries to replicate market prices. I'll describe that model in some detail, including on how we validated the model. We then use the model to quantify the contribution of various factors to the observed price decline since 2008. We use the same model to then project average wholesale prices out to 2022 and also look at the relative contribution of various factors to those future prices. Our simple supply curve model misses some of the more granular impacts of wind and solar on time of day and geographic pricing patterns. We therefore supplement our modeling with a descriptive analysis of shifting pricing patterns, particularly in several hot spots around the US with significant wind and solar. And then finally, we end the presentation with an example where some of the issues associated with high wind were addressed through transmission expansion. I'll start by describing the simple supply curve model in some detail. The primary assumption in the model is that we dispatch thermal generators starting with the lowest variable cost units, then progressively moving to higher and higher cost units as needed. These charts show the supply curve for the Southwest Power Pool based on the variable costs of thermal generation operating in 2008 and in 2017. The individual units are ordered from lowest variable cost to the highest variable cost. The height of each of these different segments represents the unit's variable production cost. And then the width of each segment represents the unit's dispatchable capacity. The segments are then colored by the fuel type and the prime mover of the unit. In 2008, when natural gas prices were high, coal units had distinctly lower variable costs than the combined cycle natural gas-fired units. And that's why you see that distinct blue region that represents the coal units on the chart in 2008 on the left. But then in 2017, with lower natural gas prices, some of the most efficient natural gas combined cycle units actually had lower variable costs than some of the least efficient coal units. These figures here are just for illustration, and in the actual analysis, we used natural gas prices that changed on a daily basis. We had coal prices that varied by state and by month, and the dispatchable unit capacity varied by season. We also assumed in our analysis that nuclear plants were always operated at full capacity, irrespective of what the net demand was. To go from the supply curve to hourly wholesale energy prices, we intersect that supply curve with the hourly net demand. Net demand in each hour is the hourly load minus the hourly wind and solar generation levels. An equivalent approach would be to add the wind and solar to the left side of that supply curve and intersect the hourly demand with the supply curve that includes that varying wind and solar. But it's easier to visualize the supply curve as being somewhat static, and instead we have all of the hour-to-hour variability limited to this net demand. And we can see the distribution of hourly net demand across the entire year as it's now overlaid on top of the earlier supply curves from the Southwest Power Pool. Comparing the net demand in 2008 to 2017 shows the impact of the significant growth in wind in the Southwest Power Pool. The net demand curve for 2017 is shifted significantly to the left in most hours, meaning that it has lower net demand, though the highest net demand hours are still almost as high in 2017 as they were in 2008. This means that the distribution of net demand is wider in 2017 than it was in 2008. The intersection of net demand with the supply curve in each hour then leads to a distribution of the hourly prices for each year, and that's shown in the far right chart. The distribution of prices in 2008 is very wide as different net demand levels intersect with vastly different supply curve levels. For example, the net demand above about 27 gigawatts in 2008 leads to wholesale prices that exceed about $65 a megawatt hour, whereas net demand below that 27 gigawatt level leads to prices closer to $20 a megawatt hour. In contrast, the very flat supply curve in 2017 means that across the wide range of net demand levels, the prices are consistently around $20 to $25 a megawatt hour. As a result, the wholesale price distribution in 2017 is very narrow despite that wide distribution of net demand levels. And then what we do is we just average the wholesale price over all of those hours to get our average wholesale price for the year. Then the distribution of prices throughout the year is characterized by the standard deviation of the hourly prices. We constructed a similar supply curve model for each of the 7 organized wholesale markets in the US. We characterized the supply curves and the net demand levels for 3 historical years. We used 2008, 2012, and 2017. To validate the model, we compared the modeled annual average wholesale price to the actual annual average wholesale price at major trading hubs in each of the markets. The chart on the left shows the very good agreement that we get between the supply curve model and the actual real-time price at the trading hubs. Again, this is based on the annual average of that real-time price. In contrast, the distribution of hourly prices within the year is consistently much narrower from the model than it was for the actual real-time markets. The chart on the right shows that the standard deviation of the hourly modeled price compared to the standard deviation of the real-time price. While the model does capture the variation in annual average prices across all of the 7 US markets, it understates the variability in hourly real-time prices. This is the reason why we complement the analysis of the drivers of annual average wholesale prices with a more descriptive analysis of the temporal and geographic patterns in the second half of this presentation. So we use that supply curve model to understand the influence of individual factors on wholesale prices by varying one factor at a time between 2008 and 2017. Our approach allows for the application of a consistent method across multiple regions and enables us to compare the influence of wind and solar to many other factors. The blue bars here show the annual average prices when we set all of their factors either to their 2008 levels or to their 2017 values. And similar to that earlier validation summary, how well we're able to replicate the actual prices in markets is shown by comparing the actual prices at the major hubs, which here is represented by the black dots, to the modeled prices in that same year. Again, that's represented by those blue bars. So we then just change one factor at a time between the base year and a change year to understand how changes in that one factor impacted average wholesale prices. And each of those factors is represented by those green and red bars. And here what we're doing is we're showing the contribution of all of the different modeled factors to the change in wholesale prices between 2008 and 2017, focusing just on the California ISO and ERCOT. And for these 2 regions, you can see that natural gas is by far the biggest contributor to the changes in wholesale prices. If you look on the right side, there's a light-colored bar, and that represents the magnitude of nonlinear interactions that can occur between multiple factors. So the blue bars come from changing everything between 2008 and 2017 simultaneously, whereas these green and red bars were only changing one factor at a time. And because of some nonlinear interactions, the difference in the blue bars is actually different than the sum of all of the green and red bars. That interaction term picks up that difference. And the larger this interaction term is, the less insightful it is to really quantify the effect of one factor at a time, as these nonlinear reactions can become somewhat important too. So here we conducted that same analysis for each of the centrally organized wholesale markets in the United States. In this case, each dot is representing the change in prices over that 2008 to 2017 time period from the changes in that particular factor for each of the ISOs. And then the gray bars behind them represent the range of impacts across all of the ISOs. What we see is that across all 7 markets, the dominant driver of the decline in average wholesale prices over this period of 2008 to 2017 was that fall in natural gas prices. The impact of changing natural gas prices was highest in markets where natural gas-fired generators were marginal in the supply stack. The impact of wind and solar on market-wide average annual wholesale prices since 2008 has really been secondary compared to the impact of natural gas. But it has been among the biggest drivers in this sort of second tier of factors that all have somewhat similar magnitudes and impacts. That also includes things like the expansion and retirement of other thermal generation capacity. We see changes in demand, changes in generator efficiency, that's represented by the heat rate column, changes in coal prices, variations in hydropower, and in particular based on the rainfall and hydropower potential from year to year, and then also changes in emissions. The magnitude of the impact of wind and solar on average wholesale prices primarily depends on the incremental level of penetration within that market. Where we have a higher share of wind and solar also leads to greater impacts on prices, as shown here. In most of the markets, the total impact on average prices in 2017 was below about $1.3 per megawatt hour. California is somewhat of an exception to this, where we see that the solar growth is estimated to have reduced prices by something closer to $2.2 per megawatt hour. That perhaps foreshadows greater impacts from solar in other regions as solar penetrations grow. The impact of VRE on average wholesale prices that's reported here in this chart is within, but often on the lower end of the estimates in that previous literature that was summarized in the earlier literature review table. In some cases, this lower impact that we see from our model can be due to a variety of different factors. One of them is that some of the literature has a different choice in the starting year, or it includes different years that have higher gas prices and therefore have steeper supply curves. Also, our use of the simplified fundamental model is somewhat different than the regression models that are often used in much of the other literature. There's also some differences that might exist due to improper or imprecise methods used in some of the previous literature and also in our interpretation of it. So since 2008, average annual natural gas prices have fallen and they've remained at much lower levels, whereas the share of VRE generation has expanded rapidly in some of these markets. So here we examine the relative impacts of different factors on wholesale prices over a period with these low gas prices and relatively stable wholesale prices. This is from 2012 to 2017 now. So this is after sort of the shale gas revolution that really depressed prices and it has kept natural gas prices quite a bit lower than in that historical period. And first off, what we see is that there's actually a lot less wholesale price change to actually explain between this 2012 to 2017 period. The average wholesale prices changed by less than about $3 a megawatt hour, as shown by the black X's in each of these market regions. And in some of these regions, natural gas prices were still the largest contributor to the limited wholesale power price changes. But then depending on the region, factors that decreased prices on par with VRE include thermal generation additions, decreases in coal prices, and also more precipitation and therefore hydropower production in the California ISO. We can also take this supply curve model and use that to project future wholesale prices in the near future. So here we used EIA projections of factors like fuel prices, generation additions and retirements, and demand growth to estimate changes to wholesale prices now between 2017 and a future year of 2022, again focusing on all of the 7 organized wholesale markets. On net, the wholesale power prices are projected to increase out to 2022, largely due to projected increases in natural gas prices. The projected growth in variable renewables mitigates the price increases, particularly in the case of solar growth in California. EIA's modeled projection of VRE growth results in a doubling of the solar penetration in California between 2017 and 2022, leading to several instances in the simple supply curve model where the net demand ended up being less than the minimum generation levels for nuclear and combined heat and power units. And prices in these hours were therefore set by an assumed negative bid price for curtailing renewables. And because this future negative bid price is quite uncertain, The CalISO results are also shown both assuming a curtailment that occurs at a price of 0 and assuming curtailment that only occurs when prices are below -$10 per megawatt hour. The estimated impact of solar on wholesale prices in California far exceeds the anticipated impact of wind and solar in all of the other markets, even with solar curtailment assumed to occur at a price of $0 per megawatt hour. But many factors can impact generation expansion and retirement decisions, including the impact of expansion of VRE. So this makes it difficult to rely on only one source for future projections. Projections from other sources include considerably greater wind and solar deployment in most markets than EIA's reference case by 2022. However, EIA's projections for solar and CalISO is relatively optimistic compared to more muted projections from some of the others, including Bloomberg New Energy Finance. So if instead we use generation expansion and retirement projections for 2022 from ABB's Velocity Suite as an alternative to the EIA reference case, this results in overall similar conclusions as presented above, but the primary difference in the alternative case is that we see smaller impacts of solar and CalISO and greater impacts of wind relative to impacts based on EIA's model projections. That's particularly true in SPP, the New York ISO, and in ERCOT. And again, this is because of greater amounts of wind that are being added in those cases. And what happens is that in these particular regions, with the greater amount of wind that's being added in these alternative cases, we also see more frequent negative prices happening along with the growth of wind. And then also, again, we see solar growth and CalISO still has the overall greatest impact on decreasing prices. Okay, so that previous analysis was all based on that simple supply curve model I talked about earlier. But that model cannot capture some of the more granular changes in the distribution of prices, changes in the temporal patterns of prices, and changes in the geographic patterns of prices. So to complement that analysis, this next section examines historical market pricing trends and VRE impacts at smaller regional and local levels through analysis of historical patterns of nodal wholesale power and energy prices. And here we're particularly highlighting the effect of negative wholesale prices. Negative prices indicate that generation is exceeding demand, and this is sort of a proxy for periods and locations where it can be challenging to integrate growing shares of VRE into power markets. And what we see is that the expansion of VRE has led to some significant changes in locational, time of day, and seasonal pricing patterns in some regions of the country. So for this part of the analysis, we're evaluating hourly wholesale pricing patterns at all of the more than 60,000 pricing nodes across the United States. But again, we're going to be focusing primarily on the ISO and RTO regions. We're also going to evaluate a number of constrained pricing areas, what we refer to as hotspots, to highlight the myriad drivers for pricing variations that occur, again, based on location, time of day, and season. When going through this data, one of the things that we first noticed is that negative prices are really on the rise. In 2017, 34% of all of these pricing nodes across the country experienced negative real-time prices in more than 5% of the hours. Negative prices are increasing also in the day-ahead markets, though they remain much less common than what we see in the real-time market. These negative locational marginal prices were very frequent in California. We also see them spilling out to other parts of the West. They're also pervasive across the wind-rich regions of Southwest Power Pool. We see them growing across parts of Texas. We're also starting to see them appear in northern parts of New York, in Maine, and in New Hampshire. In California, for example, most nodes experience negative LMPs in at least 6% of the hours of the year. And the places where we're seeing these negative prices occurring is generally correlated with places where we see significant wind and solar deployment. The negative locational marginal prices in some regions, such as California, are really largely system-wide events, whereas in other cases we see that negative prices are kind of more localized, and those can potentially be addressed through enhanced transmission infrastructure. So the measure that we use to try to quantify the degree to which negative prices are occurring simultaneously across markets is this metric up in the top left, where we're looking at the percentage of negative price events that occur when at least 75% of all nodes have negative price events. So high value indicates that negative prices are well correlated across the entire market, whereas a low value indicates that negative prices tend to be more localized. Negative prices in SPP, for example, tend to be, that's the gray line in the chart here, they tend to be less correlated than in the CalISO. That's the blue line on that chart on the left. This suggests that there's positive prices somewhere else in the market and that the negative prices might be able to be mitigated with transmission expansion. One of the things in this metric that you can see is that there's quite a bit of variation from year to year, and so we've sort of highlighted a few things that might cause this, this trend to shift. So in CalISO, for example, we suddenly see prices being much less correlated in 2015, and that was in part due to an outage on Path 15 that really caused separation between the Northern California and Southern California region. And once that outage was back in normal operation, we see that negative pricing events again become very well correlated across all of CalISO. Whereas up in the ISO New England, we've seen negative prices that sort of were occurring everywhere in the system, but those were fairly limited in ISO New England. And now as we're starting to see some of these transmission-constrained regions with wind, we see that that metric is becoming less and less correlated, which means we're starting to get sort of isolated pockets of negative pricing that are occurring in ISO New England. And then finally, we'll talk a little bit more at the end about ERCOT, where you can see that as prior to the CREZ expansion, we saw that negative prices were not very well correlated in ERCOT. And then as the transmission was expanded, then negative pricing that still occurred after the transmission was expanded was much more correlated across Texas. And then over time, we see the transmission constraints again on the rise and that sort of lack of correlation across all of ERCOT in the orange line. So we're going to look at a few hot spots where we see this increased negative prices and try to really determine if wind and solar are the driving factor. In particular, in the SPP region in Oklahoma, we see that prices tend to be lower when the wind is blowing, even given the same load levels. And similarly, negative prices are most likely to occur during the high wind, low load times. These charts on the left take the load and break it up into different deciles between sort of the low load and the 40 to 50% of peak up to the peak load levels. That's what's shown on the vertical axis of these charts on the left. And then on the horizontal axis, we're showing the wind at different levels. And you can see that as you go to high wind levels, prices tend to be lower. And also high wind levels, you lead to more negative prices occurring. That also tends to occur at times when you have lower load in SPP. The figure on the right shows that wind is generating more during these negative prices than it is during times of positive prices. And similarly, the load is lower. It also shows that some of the thermal plants are responding to these negative prices by generating less. Though not all of these generators are exposed to these prices, and so not all of them are responding. You can see, for example, there's still quite a bit of coal that's generating and online during the negative price times in SPP, and the nuclear plants, for example, are not responding at all to these negative prices. The effect of solar on the patterns of wholesale prices can best be seen in California. Specifically, increased solar generation in California has shifted the time of day profile of wholesale prices to be lower in the day and higher in the early evening, particularly in the spring months. Between 2011 and 2017, average CalISO prices didn't change significantly. However, the midday prices in the spring were about $30 a megawatt hour lower in 2017 than they were for the same hours in 2011. Then the summer evening prices in 2017 were about $40 a megawatt hour greater than in 2011. We looked to see if it was high ramping needs that are due to the evening decline in solar output, to see if that contributed to these price spikes. And you can see that there is some correlation, but it's not just solar ramping alone. Most of the summer evenings in 2017 contain these equally high net load ramps, but they had somewhat lower load. And so you didn't see these corresponding price spikes. So it's really only the combination of having a big ramp and high net load that led to these price spikes that you can see in the summer of 2017. Now, the decrease in 2017 prices during the daytime hours in the spring and in the winter was in part due to an increase in the frequency of these daytime negative prices. The distribution of negative prices over the spring and winter days in 2017 clearly follows the pattern of solar generation. If you look at 2011, on the other hand, negative prices were actually much more likely to occur during the night or in the early morning in the spring and the summer. So this leads to one other interesting insight, is that 2017 actually wasn't the year with the highest frequency of negative prices in California. Instead, 2011 actually had higher frequency of negative prices in the real-time market. There's many different factors that can contribute to these negative prices. In particular, if you look at in 2011, there was higher hydro generation, and there was also a lot more nuclear generation then, prior to the Songs generation plant being retired. One of the other things that's noticeable is that the imports were a lot less flexible then. So the gray bars in 2011, you can see that the imports are not really responding to the negative prices. And really in 2011, there was only a small amount of wind and hardly any solar at all. But now, if you go to 2017, we see a lot more solar that's coming online, and we see that the hydro is again somewhat high. So we're seeing some negative pricing occurring. But now we have less nuclear plants online, so we see that sort of mitigates the negative pricing to some degree. We also have much more responsive thermal plants and imports. So if you look in 2017, the thermal plants during negative price times are generating at a far lower level during negative prices than they were during positive price hours. And imports in 2017, again, are much more responsive to negative prices than they were in 2011. And so to some degree, the thermal plants and the imports have helped to mitigate the negative prices that might otherwise have been expected from the growth in solar. The other thing we see is that there's an important interplay between transmission expansion and negative prices. So in Texas, in 2011, there was quite a bit of negative pricing that was happening in the far western part of Texas. Then with the expansion of the CREZ transmission lines, you can see that by 2014, when all of these lines came online, that a lot of that negative pricing was largely eliminated. Though as we start to go forward to 2017, we're starting to see some of those negative prices occurring again, but they're no longer as limited to West Texas, and they're starting to spread out more across ERCOT as a whole. So transmission can play an important role here in interacting with the negative prices, and it's something that can mitigate that. And in the report, we also talk about similar sort of transmission expansion that has reduced negative prices near the Quad Cities nuclear plant up in Illinois, in that region. But it's not just the frequency of negative prices that's interesting to look at, but also a question of the magnitude of those negative prices. So here we're looking at a metric of how much negative prices are actually bringing down the average prices. And we can see that, again, the most notable impacts of negative prices on average prices are occurring in the SPP region and then in northern New York and the ISO New England region. California doesn't stand out as much here. Even though we had frequent negative prices, the magnitude of those prices wasn't very large. And so the effect on average prices wasn't as significant in California than it was, for example, in the SPP region or in those places in ISO New England and northern New York. That also raises one other interesting point here, is that the negative prices are actually primarily impacting assets near wind and hydro and solar, and they're having less impact on prices near other types of generation. So here what we're doing is that we're taking all of the nodes that are near different assets. So in this case, we're taking all of the nodes that are near wind, and we're looking at the impact that negative prices have on wind nodes, and showing that with the green line on the left. And then in contrast, we have negative prices that are occurring near coal plants, for example, in the black line on the left. And so there are some negative prices that are happening near coal plants, but they're much less frequent and have smaller magnitude than what we see occurring at pricing nodes near wind plants. And so that growing amount of negative pricing is actually having the most significant impact on average prices near wind nodes, and then also growing amount near solar and hydro plants. And for some of these other units like coal, nuclear, and gas, the effects so far have been somewhat smaller, though we can see a trend over time that they're starting to increase in the effect that negative prices are having on those assets. And then if we just look at 2017, you can see that there's quite a big distribution of impacts that are happening. So there are some particular coal plants, for example, that are having pretty significant impacts from negative pricing on some of the coal plants. But that tends to be fairly rare relative to most of the coal plants across the U.S. And then if you look on the right-hand side, for example, for wind, you can see that it's a bigger impact where negative prices are reducing average prices by about $1 a megawatt hour or so near average wind plants across the United States. Okay, so the conclusions from all of this is that we see that the decrease in market-wide average wholesale prices since 2008 was really largely due to these changing natural gas prices. And the historical effect of wind and solar has been limited in part due to these flat supply curves that we see in 2017 driven by the lower natural gas prices. But beyond the impacts to market-wide average prices, what's been more consequential are some of the impacts of wind and solar on temporal and geographic pricing patterns, where we've seen some pretty significant shifting in that. And in particular, we see the frequency of negative wholesale prices is on the rise, and that we do see that that's driven in part by wind and solar growth. And sometimes we can see that those wind-related impacts are due more to transmission constraints. That means that the negative pricing has had much greater impact on wind and solar assets than on some of the other generation assets so far, but we do see the spillover impacts that are starting to become more and more apparent. The magnitude of and importance of these shifts in the longer term depends on what other disruptions occur, including efforts to actively mitigate these grid effects of wind and solar. And one of those, again, in some of these regions can be transmission expansion. That covers the presentation. Again, the slides here were all summarizing a report that's available at this link that's here. From that link, you can also download the briefing slides that I presented today. You can also find on our website a link to other presentations and work that some of this is based off of, and sort of a broader array of research that we've done focused on renewable energy. And I'm happy to start going through some of the questions now, and then also feel free to follow up. My email address is listed here on this slide, along with my phone number if you're interested in talking further.
Great. Well, thanks, Andrew, for going through that content. And we do have a good amount of time for some Q&A. We have a few questions already, which I will help deliver. But as others come in and folks think of them, please insert them into that Q&A chat box, and we will address them as we can. Maybe to start, just a couple of questions related to coal, Andrew. One related to coal plant retirements, and specifically for the purpose of the annual market-wide average analysis that you conducted, both the historical as well as the near-term forecast. How do we reflect both recent and planned coal retirements?
Sure. So if we look at the historical analysis, what we're doing is that we're changing one factor at a time. So in 2017, we're going to sort of have all of the assets that actually were operating in 2017. And then in 2008, we'll have all of the assets that are happening that were operating in 2008. So there will be retirements reflected in the generation that's available between those 2 years. And so in 2017, if plants had retired, we would reflect that retirement in a changed supply curve in 2017. And then if we want to sort of try to tease out what impact those coal retirements have had on electricity prices, let me just go back to an example of those figures here while I speak about it. So this is where we can look at the far right-hand side of the thermal retirements. So this is an example where we change one factor, which is just the retirements that have occurred between 2008 and 2017, and try to see what impact that has had on wholesale prices. And in general, what you can see here is that between 2008 and 2017, the retirements that have occurred over that time period have tended to increase average annual wholesale prices. And some of this is driven by coal plants retiring, but the one that stands out the most is actually California ISO, where that's the retirement of the SONGS generator. So it's not limited to just coal plants, but also thermal generation. So because of the lack of that generation being available in 2017, that's led to wholesale prices being somewhat higher in 2017 than they otherwise would have been with the coal plants still available. And then if we go forward to the projections for 2022, the way that we did this was that Annual Energy Outlook has a projection going forward of what the generation mix will look like out into 2022 on a regional basis. And I think this is actually by the energy market region, or the EMM regions that they use for Annual Energy Outlook. And what we did was that we took basically our 2017 generation mix and we scaled it appropriately so that our mix in 2022 would reflect whatever AEO was projecting for 2022. So in cases where there were planned retirements that had been announced that were reflected in AEO, we would then scale down our generation appropriately to reflect those retirements. And then in our sort of sensitivity case where we instead used ABB's velocity suite, this will look on a unit-by-unit basis and actually have sort of in particular units that have been announced to be retired or planned to be retired by 2022. So we again reflect that in these results and have that built into our final analysis, and then we try to tease out how big that effect will be by, in this case, looking at the thermal retirement section. And so you can see that in some regions, particularly say PJM, for example, you can see a pretty sizable increase in prices that's being driven by the retirement of some of the assets, somewhere around $2 per megawatt hour out to 2022.
Okay, great. Thanks, Andrew. Another question here related to curtailment and sort of questioning why solar plants would not curtail until negative price territory. Kind of the intuition is with the production tax credit, wind plants will only curtail oftentimes at very negative prices, but kind of wondering why a solar plant wouldn't curtail at around zero, but would instead only curtail with more deeply negative prices. Any reaction to that question?
Yeah, that's a great question. And again, I think the intuition behind wind is much easier because of the PTC. For a solar plant, without having the PTC to drive that, one thing that they still have is that every megawatt hour that you generate from a solar plant is going to generate a renewable energy credit that can either be used by an off-taker to meet a mandatory RPS obligation, and so it counts towards their RPS if they can generate that megawatt hour, or it would be able to be sort of resold in a voluntary market, would have some economic value on a voluntary market. And so we don't have really clear visibility onto what that level would be, but instead what we can see is we can see some sort of correlation of how far negative prices go, and that does tend to go below zero in some of those hours, and those correspond to hours where we do see some solar curtailment. And in California, for example, that was happening around negative $10 per megawatt hour. So what we're thinking, the intuition behind that is that if say an investor-owned utility has a contract with a solar plant, they wouldn't want that solar plant to curtail because that would then force them to find renewable megawatt hours somewhere else to help them meet their RPS obligations. And the value of that sort of that lost renewable energy credit in California might be somewhere around $10 a megawatt hour. And so again, it's really something that's hard to get visibility on, but in this case, we're just sort of basing that assumption on the behavior that we see in recent years on negative pricing and solar curtailment.
Okay, another question maybe more on the negative price side of the piece of work rather than the annual averages. Obviously, Andrew, you spent a lot of time talking about and thinking about negative prices, but what about positive price spikes? Did we look at issues related to the impact of wind and solar in the positive direction, and did those offset the negative prices that we otherwise have observed and that you nicely summarized in the presentation?
Yeah, another good question. So for the most part, what sort of drove our interest in negative pricing is in part because there's a lot of discussion about that, and you don't see as much of a discussion on positive prices. But then the other thing we looked at, and I didn't present today, but it's in the report, is that we looked at just the distribution of prices across all of the nodes in the U.S. and looked at the trend that's happening over time. And we looked at the distribution of high prices, sort of median prices, and then low prices. And one of the things that we saw is that in 2017, we suddenly start to see this much more frequent occurrence of negative prices occurring across large parts of the U.S. So we start to see sort of this this growing negative price impact. We didn't see anything like that on the positive price side. So positive price spikes occurred quite a bit back in 2008. That you'd see a very high price distribution across different regions. But then as we go to more recent years, we have not seen an increase in positive prices. So to begin with, there wasn't as much to look for based on that sort of survey that we did looking at all of the prices. That said, when we did look at California, there was this interesting trend, again, that you kind of see standing out that was somewhat unique in California, again, in 2017, whereas there's a suggestion that not only has solar shifted the timing of price spikes, but that the positive price spikes might actually be higher in magnitude in 2017. And so we talk a little bit about this in the paper where we did these diagnostics trying to figure out were these price spikes correlated with solar ramps. And again, what we found was that, that they do happen around the time that the solar is ramping, but they don't happen only on times when solar is ramping. So we saw summer days where you saw very large solar ramps, but no price spike, whereas if you had a solar ramp and very high net load levels, that's when you see the prices going up. So there might be some effect of solar on these price spikes, but we didn't see that was the only cause of it. It also sort of is high net demand levels. And we didn't really find any other sort of signal like that in other regions when we looked through the data.
Great. Thanks, Andrew. A couple of questions related, I suppose, loosely to the concept of the cost to serve load. A lot of our analysis, especially early in the presentation, kind of focuses on the time-weighted or 24/7 average price, but of course, load pays a load-weighted average price. And of course, load pays not only energy prices, but also capacity payments, as well as ancillary service prices, neither of which we really cover in this particular analysis. So curious to hear your thoughts and reflections on those two components. Again, the kind of load-weighted versus time-weighted question, as well as our exclusion of ancillary service and capacity market impacts, at least for the purpose of this analysis.
Yeah. So I think, for the most part, one of the things that we were interested in is, and this is sort of the explanation for why we focused on the time-weighted part of it, was that for the most part what we were interested in is explaining why we see this time-weighted average price changing from 2008 to 2017 and trying to unpack what the drivers of that were, what that was. And so that sort of, that sets up the reasons why we go into that analysis. And the other reason why we focus on the time-weighted part of it is that if you think of an inflexible baseload generator that's effectively going to be generating in all hours of the year, then the revenue that it earns from the energy market is really that time-weighted average. It's not necessarily the load-weighted average. So the question was about sort of the overall cost to serve load, which is a somewhat different question than what we were really focusing on. And in that case, you would want to focus more on the load-weighted side of it. And we just actually didn't do those calculations to see how that would be different. I would expect that the load-weighted average prices would tend to be higher because we do have a lot of load that's occurring at these high load times, high price times. So when you have more load coming in, that tends to drive prices up, and so the load-weighted average price would be somewhat higher than our time-weighted average price that we're seeing here. And then in terms of what the effect of wind and solar would be on that relative to what we're seeing, I think I'm not exactly sure what direction we would expect that to go. So it's somewhat ambiguous in my mind. But it's an interesting one and something maybe we should think about a little bit further. And then in terms of the capacity and ancillary service price questions, so I think it's a little harder to know, again, what effects you might expect from renewables on capacity prices. So on the one hand, having additional assets go into the market that might be able to have some capacity contribution would tend to increase the supply of resources and then therefore maybe decrease capacity prices. So you might expect some effect like that. On the other hand, what assets are bidding into the capacity markets is somewhat meant to cover their costs that they're not covering in the energy markets. And so if they expect revenues to go down in the energy markets, they might have to have a higher bid in the capacity markets, and that might therefore drive up capacity prices. So again, there's sort of perhaps an ambiguous impact that would have on capacity prices, and we're not something that we were able to tease out in this analysis. And then on ancillary service prices, we have some other work that we've been doing that's not reflected here. And what we see with solar is that there actually is some trend that solar might be increasing ancillary service prices, particularly in the regulation down direction in the California ISO, whereas in other regions we don't see a clear signal that ancillary service prices are changing related to renewables. And the other, I think, aspect that's important to keep in mind is that ancillary service markets are so small, they're such thin markets and small, that even fairly decent-sized price changes aren't going to have that big of an impact on the cost to serve, whereas these energy prices and capacity prices will have a much more significant impact on the cost to serve.
Great. Thanks, Andrew. A couple more questions, at least loosely connected to the set of issues related to coal. One relates to hedging, and I suppose this applies not just to coal plants, but really any type of power plant, which might have some sort of hedging contract, either a direct hedge or a power purchase agreement that delivers to that unit a fixed price for their output. And the question is more specifically, if you're selling it, for example, $25 per megawatt hour in the forward market, might you still be generating electricity even when real-time prices are below that $25 per megawatt hour level? So kind of the question of how we address or don't address hedging contracts and their possible impact or not on bidding behavior.
Yeah, great question. So in the analysis that we're doing, we are really just looking at the variable production cost of that unit and using that to make our dispatch decisions. So we don't account for any sort of hedging contracts or anything that might insulate them from those prices. And so the results here reflect just what you would think based off of sort of those production costs. Now, in terms of what that means for the impacts that we're seeing of renewables on wholesale prices and why this analysis is still interesting, even though you might have assets that are somewhat hedged from this, is that to some degree the real-time prices still reflect somewhat the opportunity cost associated with that hedging. So, for example, that $25 megawatt hour revenue that coal plant could get from selling that, if wholesale prices were to start to decline quite a bit, then the person who is providing that hedge would sort of see that opportunity that they could have satisfied their demands at a much lower price than the $25 per megawatt hour based on that real-time market. So it somewhat indicates the opportunity cost associated with that hedge. And so we think that that's still relevant. And then similarly, you might think that a coal plant, might be able to satisfy its requirement by buying from the market at those low prices rather than generating power. So if prices go well below its variable production costs, it might go ahead and ramp down the plant and then buy power from the wholesale market to sort of satisfy that requirement. So we do think that these real-time market prices are still somewhat insightful in telling you about some of the operational decisions and also about the opportunity costs associated with hedging.
Great. And another question here related to the impact of wind in SPP in particular. And if you can go to slide 20, Andrew, the question is really specifically the kind of the surprise that higher wind output is having such a significant effect on negative prices, even at relatively high levels of electricity demand or load. Any intuition for why those negative price hours are spreading outside of the low demand hours to also the high demand hours?
Yeah, that's a very good question. So part of this, I want to sort of be careful about this. So part of this may have to do with the fact that what we're really focusing on here are those prices that are sort of isolated in this hotspot, And so whereas the sort of overall demand is sort of what's happening at the system level, and then this is sort of overall system level wind. And so I think one of the things that this is indicating is that there might be significant demand in the overall market, but because of some of these transmission constraints, that you have a lot of wind happening that might be behind those transmission constraints, it can't get out to the rest of the market. So in that sort of area that we've circled here, in that sort of Oklahoma hotspot region, that wind generation is somewhat locked in, and it's going to drive prices down, even if demand is high outside of that isolated region in the rest of SPP. And so that's sort of an indication that there might be a lot of value to having some transmission expansion that would allow that wind to move out to those places where there would be higher demand. So I really think that this is sort of an indication of sort of things being locked in basically during those times. And in the full report, you can see that we saw somewhat similar behavior in the northern region of New York, and then in Maine and northern part of ISO New England, where the same thing's sort of happening, where even during the higher demand times, if you have a lot of wind and you're kind of behind those transmission constraints, you just can't get out there, and that's going to drive prices in that localized region very low, and you might even start to get negative prices, even though the demand level at the system is quite high.
Okay, maybe just one final question here, Andrew, before we close out the webinar, and it relates to the kind of must-run constraints that exist for coal plants, I suppose, not just coal plants, but nuclear facilities and others as well, and the possible impact of those constraints, both on the average pricing patterns that we were focused on, but also negative prices. Any additional thoughts on kind of how we handle that or how we think about that in our analysis or beyond?
Yeah, so that's really one of the challenges of using a simple supply curve model, is that you have a harder time taking into account those real constraints that might occur on a power plant. So some of those might be sort of a must-run constraint that's really something that requires you to be online for a reliability reason. Some of that also might just be the fact that there's sort of a startup and shutdown cost. And so a more detailed model, like a production cost model, for example, can really incorporate that information into the dispatch and create sort of a more realistic dispatch. Whereas our simple supply curve model, we're really just sort of looking at that variable production cost and moving across that supply curve just based on the merit order, and we're not really reflecting some of those true constraints. So what that means is that our simple supply curve model is going to have a lot less variability in prices than a real market that has that reflects those constraints. And so I think that's part of the reason why we see that our wholesale market, our modeled wholesale prices have a lot less variability than real market prices do. And in part, it's because of those sort of thermal plant constraints, and then also maybe because of various transmission limitations. And so that does have some effect. In particular, that's going to limit our ability to really pick out some of these low price events to some degree. And again, that's why we sort of supplement that with this more detailed analysis. And I think that sort of is potentially, exactly here again on slide 20, that could be one of the things that explains why you see negative coal plants still operating at negative prices. Part of that could be because there are some significant startup and shutdown costs that would keep a coal plant from turning off during those times just to avoid negative prices, and instead they sort of make the decision to ride through that and stay online to avoid a costly startup and shutdown. And so in effect, what they end up doing is that constraint contributes to exacerbating that condition and making negative prices potentially more impactful and more frequent because of those constraints. If you had a more flexible unit, you wouldn't have that issue, and you could just shut it down, somewhat more similar to what we end up seeing in our supply curve model. So just in terms of a future refinement of this, kind of incorporating those constraints in more depth into our model would be one of the things that could improve our modeling perhaps. And it just becomes quite a bit more data and computationally intensive versus using the simple supply curve model.
Okay, great. Thanks, Andrew. And we have reached, actually, we've exceeded the end of our time, so we'll end the webinar here. I do want to thank those of you who have remained through the Q&A session. Thanks for your questions. Hopefully the answers were helpful. And if any of you happen to have any other lingering questions, either those that you inserted that I was not able to get to or others that have arisen since, please do feel free to reach out to Andrew or me. But again, thanks for joining the webinar. Hope it was helpful and hope everyone has a good rest of your day. Thanks much.
Thank you.